For the viewer watching us right now, that life-changing moment, that moment when you had that connection with Michael Lewis, the author of Liar's Poker and The Big Short. I mean, how did that change your life, and what was the genesis of that relationship?
So he had contacted Meredith Whitney sometime in 2008, and he had asked Meredith, "Hey Meredith, who are the people that I need to be talking to that understand this crisis?" Well, Meredith obviously is very tight with Steve and Vinny and me, but more Steve and Vinny at the time. They worked together. So next thing you know, we get a phone call, or Steve gets a phone call from Michael Lewis, and Steve was probably like, "Wow, yeah, sure, come on in. What are you working on?"
So good for Michael. I mean, he's looking at this before Lehman went down. He's poking around.
Oh, he's poking around.
Good sniffer.
Because you know that, because his History at Solomon, Liar's Poker kind of was the first cynical book written about cynical view of Wall Street. And so believe me, his antennas were up, and he knew something was wrong. And by that time, things had already started to, somewhat decay, or I should say very much decay at that point. So his first iteration was coming in and talking to us and other people he found out about later, who he interviewed in the article and in the book, about what was happening, how we thought about things, why we were doing the things that we were doing. So it was an ongoing collaboration in terms of getting him information, answering his questions. And so we wrote an article in the fall of 2008. And then next thing you know, 14, 15 months later, published the book in March 2010 called The Big Short.
How much time did you spend with him during the writing process? Was it?
I think off and on all of us he would call or email like, "Hey, who's this person? Hey, what does this bond mean? Really," and he's amazing. He's an amazing, not just interviewer and writer. He asks the most pertinent questions. There's no waste of time with him. He truly understands, but he picks up so much of human nature. He likes characters as much as he does facts. So I'm not saying I'm a character. I mean, Steve's a true character, right? Steve's a bigger than life, larger than life personality, and I think that what's attracted Michael, at least to our team, was certainly Steve. And so fast forward from The Big Short in 2010, 6 weeks later, the flash crash happens. And Michael has stated this publicly. I called him that day, and I said, I was obviously sweating and in a panic and whatever. It was probably that day or the next day. And I said, "I have your next book." And he's like, "Well, no one really tells me what to write, but what do you mean you have my next book?" I go, "You got to do something on this flash trading." I said, "What I just saw happen and all these bids being pulled and offered." I had just met recently, but in the last year, in 2009, Brad Katsuyama and Ronan Ryan, who have now started IEX, the Investors Exchange.
Katsuyama, yes.
And so I said, "Michael, when you're ready, you let me know." Well, the next thing you know, he meets the Russian coder from Goldman Sachs that was accused of stealing code, and he calls me back maybe a couple months later and says, "I really would like to meet Brad and Ronan and understand this high-frequency trading and what it means." And so that made me incensed, not that Michael called me, I'm saying just now uncovering the high-frequency trading, because I learned at the same time Michael was more and more about how this process works of trading. So Michael and I obviously worked together. He worked more with Brad and Ronan on that, but I worked with him during that period also. So to cross over from Big Short right into Flash Boys was just surreal. It was almost as if it just kept going, because it never ended. There was never separation for me between the Big Short and Flash Boys. So I still talk to Michael from time to time. I read all of his stuff, obviously. I think he's a brilliant writer. He might have sold a few more books than you have at this point, although
yes.
12 different languages, I don't know. I check and see. But no, it's been a great on and off relationship in the sense of I talk to him every so often, but I have no idea what he's working on right now.
And what's the one story that you appreciate the most that was left out of the book?
I guess there were some changes. Well, the book pretty much captured a lot of the stories. The movie probably missed a couple things, but the book itself was pretty accurate. I think the one thing that people don't appreciate or understand is that the vantage point that we had, we were an equity long-short fund, right? And we had longs in the books and shorts in the book. And this was really Steve compiling the portfolio. And we were able to clearly see in real time what fixed income was doing to these positions. So we had longs, we had shorts, and then we were short the bonds, so to speak, long credit protection on the bonds themselves. So
this is fascinating. So you've got the equity,
yep,
and you're looking at CDS versus the F, so credit default swaps, so the cost of credit default protection
on the companies that we
actually the companies
short.
Versus the equity.
Exactly.
That's a great relationship to watch, and a lot of people watching us right now aren't familiar with that. So that's where you're getting back early. Oftentimes the credit will lead the equities. Is that what you saw?
Yes, credit leads equities in that sector always. If you're making mortgages or whatever loans you're making, credit will always lead because eventually it backs up onto your balance sheet.
So in other words, if an investor is watching us right now, they own a stock XYZ and stock's like $8, but meanwhile they have all these bonds, and the company has all these bonds. The bond prices might actually be moving down while the equity's moving higher or sideways.
Yes.
And so you get a leading indicator by watching the bonds.
Rarely is there a disconnect. Sometimes there is, but rarely. In this particular case, it's almost redundant in the sense of you're buying credit protection on companies who are producing loans that are being sold into the marketplace and also sitting on their balance sheet. And so I think the one thing I would say that wasn't really reflected, or maybe it was, maybe it wasn't, was the amount of work that went into the equity side of the equation that allowed us to cross over and see what was happening in fixed income. So when our returns, which were obviously substantial in 2007 and 8, a lot of that, I'm not saying it was a third, but we made money being long certain stocks, we made money being short certain. We may be long the mortgage REITs, right? Because the Fed's going to have to cut rates precipitously, so go long mortgage REITs or go long REITs of some kind. So it was a blend, but I think having a viewpoint of equity and credit at the same time was helpful. And I was probably one of the few traders at the time that could speak the language and talk to both the equity desk and hang up and call the fix of the same firm.
Not many people can do that.
Deutsche Bank or Lehman. Yeah. I used to call you and talk to you guys, and I would talk to your equities trader who was bidding for Countrywide. I'm like, why would you bid on Countrywide Financial here when I'm watching their bonds right now trade down? So you and I used to have those conversations. So that disconnect I was probably rare. I got lucky to be in the seat that I was in, but we took full advantage.
And most people don't know, but like when you're at a bank, you've got an equity floor and a fixed income floor, equity versus credit.
Sure.
These two groups don't even like each other.
Right.
So,
right.
So they don't communicate.
We always used to say, when fixed income has a great year, they get paid great. Equity's okay. When equities has a great year and fixed income doesn't do well, nobody gets paid.
That's right.
Because the balance sheet is being absorbed in the fixed income side. So yes, fixed income always frowns upon the equity guys as the dumb people in the room, and they're smarter. I won't ask you what your viewpoint is on that, but yes, that's always been the case at the banks, for sure.
So bring it back to modern day and the road ahead. You're looking at, the global picture. We're looking at the U.S. picture, looking at Fed policy. What most interests you today about the U.S. economy in terms of economic indicators, changes in the economy, something that trends that either disturb you or trends that inspire you? I know you've done an incredible amount of work with in the cannabis space,
right?
But that's different big trends.
Sure.
A bullish trend, a bullish thesis, and maybe a more bearish thesis. Give us your bullish thesis.
On a sector specific,
yeah.
You want me to talk about cannabis?
Yeah.
So that actually dovetails into what my bearish thesis is within the economy. Things are fine, but they're somewhat stagnant, obviously. And we've already seen what can happen when you try to raise rates and how quickly things can slow down and how much leverage is really in the system. Cannabis is one of these sectors, and I would throw sports gambling into the same sector, two kind of 10th Amendment type businesses that have the ability to generate a lot of tax revenues for local economies and the government for that matter if it's done correctly. So cannabis is interesting from the jobs that it can create, the wellness benefits of it, the politics of it. Obviously, 94% of people approve medical cannabis and 60-something% approve recreational. So it has all.
So let's get into politics real quick.
Yeah.
Canada is ahead of the U.S.
Right, in October last year, they allowed recreational marijuana. So.
Okay. So at the Bear Traps report, what we do is we'll take clients around the hill, around Washington,
sure.
and kind of get into this. And it's important that investors realize that you've got Canadian companies that are much more advanced because
sure.
of the banking
Correct.
relationship. Whereas get into where the Canadian banks are in cannabis versus U.S. banks.
Sure. So I would say not just the Canadian banks themselves, the Canadian growers, the Canadian cannabis companies are in a better position because they have access to the banking system in Canada. Because they're listing on our exchanges, the NASDAQ and New York Stock Exchange, they have the ability to raise capital and can be owned by U.S. institutions. It's as simple as that. The U.S. names trade on the Bulletin Board of the United States, and most of them trade on the CSE up in Canada. So the smaller exchange of the two versus the TSX. You can't be listed on the TSX and own assets. Toronto Stock Exchange and own assets in the U.S. for cannabis. But you can be on the CSE and own assets. So you have U.S. companies that are listing in Canada, Canadian companies listing in the U.S., and you have this weird, right? That's a weird situation. And so all of a sudden, throw hemp into the equation, CBD into the equation, which was the stepsister of the cannabis plant in a weird way because it was never really, it was kind of already sold on the marketplace and people just aren't that familiar with it. All of a sudden, the amount of investment going into hemp, because why? Because banks feel like they can touch that. U.S. banks feel like, oh, much more comfortable lending into the hemp market, to the CBD market, because
so the
Farm Bill passed. Yeah.
Okay, so in the United States, the financing / banking arm of the hemp space is ahead of
Correct.
the cannabis
Way
space.
ahead.